All right, we're on the next learning objective, and we are going to define debits and credits, normal balance, and double entry accounting and T accounts. Okay, this is going to be a little bit longer video because I really don't want to break it up. Okay, so let's kind of talk about double entry accounting. I think we might have touched on it in the previous chapter, but if you think about it, every single transaction affects at least two accounts. It could be more than two. Okay. Think about, I always use the example, if I have $100 in my pocket and I go to Walmart and I spend $100, I give them $100 cash and they give me $100 worth of groceries. Two things have happened there. My cash decreased and I don't really inventory my groceries, but my grocery inventory went up. So every single transaction will always have two accounts. Okay. Sometimes it's easy to try to figure out one of the accounts, and then you can sometimes reason the other half of the equation. And I tell students to do that because it's better to get it halfway correct than be completely wrong. Always try. Okay. So they give us an example. Office supplies are purchased for cash, requiring an increase in office supplies, which is an asset, and a decrease in cash, which is also an asset. Okay. So we use T accounts in accounting. We love our T accounts. You probably, if you are an accounting major and you go out into the real world, you're probably not going to see the T accounts. But there's a lot of people who will take a scratch piece of paper and write a T account out to understand a journal entry. Okay. So let's talk about debits and credits. This is probably the thing that gets students confused the most. Okay. So let's talk about the definition of a debit. Okay. A lot of students think of their debit card and then they start thinking about their checking account and money going in, money going out. Some students will think of it as an increase, okay, or a decrease, okay. A credit, I have students tell me they think of their credit card, okay, and they also may think increase and decrease, okay. None of those are correct. I know, I just made you write all that down, mark through it on your piece of paper because none of those are correct, okay. A debit is the left and a credit is the right. Okay. If I could just take the words debit and credit out and just say left and right, I think my job might be just a little bit easier because other industries have taken our accounting terms and they've used them for other things. And that's not what they mean in the accounting classroom. Okay. Sometimes they'll think a debit is good and a credit is bad. They're neither. They're neither good nor bad. Okay. They're just left and right. And it's just how we organize the accounting records. Okay. This is very, very important to grasp. Okay. And we're going to go through a lot of examples as we go through all of these videos. Okay. So left and right. All right. So I am going to come over here and I'm going to draw the accounting equation out again in T accounts. Okay. And you'll kind of see the reason I do it this way here in just a second. Okay. I always put withdrawals up underneath owner's equity, and I put expenses underneath revenues. And remember, revenues and expenses have their own statements. They are underneath that umbrella of owner's equity, but they have their own statement. All right. So debits on the left, credits on the right. Every single one of these that will not ever change. Okay. You can't memorize a million different journal entries and transactions, but you can memorize these debit and credit rules. Okay. And you don't know them until you can take a blank piece of paper out and write them cold. Okay. Every one of them. While you're working on your homework, you have this sheet of paper in front of you, okay, so that you can answer questions efficiently and effectively. If I was to walk in and take the CPA exam today, I would write these out and I'd have them right there. Not because I don't know them, just because it's going to help me answer the questions correctly and more efficiently. Okay. So the first thing we've got to understand is what is the definition of normal balance? Okay. Every one of these accounts are going to have a normal balance. What do we mean by normal balance? We are looking at the side where increases occur. Okay. The side where increases occur. All right. So I'm going to do assets and we're going to kind of walk through the rest of them, kind of just, just basic terminology and kind of reasoning it out. All right. Assets will always have a normal debit balance. So what that means is if I want to make an asset go up, an asset's cash, accounts receivable, office supplies, prepaid a prepaid rent. All of those are assets. If I want to make them increase, I'm going to debit it. Okay. If I want to decrease it, I will credit it. Okay. So now let's think about, we're going to cross the equal sign. And in math, what happens? I know accounting's not really math, but it is an equation that has to stay in balance no matter what. Usually the opposite happens, right? Okay. The opposite happens. So when we come over to liabilities, they're going to look opposite of the assets, right? So my normal balance for liabilities will be a credit. So if I want to increase a liability, I will credit it. Okay. If I want to decrease the liability, I will debit it. Do you see now why a debit or credit is not good or bad? It is just how we are recording entries to get them to a form where we can make decisions. Okay. Owner's equity is added to liabilities, so it looks exactly the same as liabilities. Okay. Revenues are added. They look exactly the same as the liabilities and owner's equity. Okay. This is why I do it this way. Okay. Makes it a little bit easier to understand. All right. Withdrawals, that's where the owner takes money out. Withdrawals are going to decrease the owner's equity, so they're going to look opposite. So withdrawals will have a normal debit balance. Okay. And if we wanted to decrease a withdrawal, then we would credit it. Probably only time that would happen would be an adjusting entry. Okay. Remember, revenues and expenses have their own income, they have their own statement. And it's the very first one, the income statement. We have revenues at the top, then we subtract all the expenses. So expenses are going to look opposite of the revenues as well. Okay. So I don't care what you do, but you have to memorize this. And I have been known to come into the classroom and do a pop quiz on this right here. So if you've watched the video and answered the questions and you understand it, you'll get some bonus points on a pop quiz. Okay. I'm going to jump back over here to my PowerPoint, and they only did assets, liabilities, and equity. I don't really like the arrows going up and down. It kind of messes with my ADHD. So I just do it the way I did. Okay. So right here, they give us an example. This is not necessarily a journal entry because if it was an entry, we would have to make both sides balance. They're just showing that if I'm increasing cash, then I would debit cash of 30,000 to the cash account. If I was decreasing the cash, then crediting the cash is what we would do. Okay. All right. I've already expanded this. I've already done this on the previous page where all the accounts, and you can kind of see this equity umbrella that all of these fall underneath the equity. But remember, revenues and expenses have their own financial statements, so they kind of stay separate from the rest of the equity accounts. Okay. I've already talked about normal balances. Everything that is in this is what I wrote out over here. Okay, it's the exact same things. If this helps you memorize it better, then that's fine with me. I don't care, but you have to understand how those debit and credit rules work. Okay. All right. So using a T account, we have a T account here. I believe these are probably numbers that came from the problem we worked back in chapter 1. So this just shows everything going on with cash. It's not giving us a journal entry, just everything going on with cash. So we had cash come in at 30,000. I believe that's when the owner put money in the business. We had cash go down of 20,000, which I think we bought land or something. Okay. And we're going to end up with a balance on the normal balance side. Cash is an asset. Assets have a normal debit balance. Okay. You could flip over and have a negative balance. That means you're negative in your checking account, which is not a good thing. It does happen. It is kind of rare in the accounting classroom to ever see that, though. Okay. All right. We will pick up in the next video on the next learning objective.